you'll probably see huge government spending supported by the Fed, which will no longer be looking at the stock market, but looking at the physical economy. And we're moving towards that. They can use central bank digital coins to try and accelerate that process in terms of where money flows to and to micromanage the economy, which China's already starting to do. But you do that with made in America caveats, again, using maybe digital currency to understand who's trading with who, so it can't just flow offshore. You do that behind tariff barriers. You do that alongside a spending plan where you subsidize companies to bring production home and raise wages. And yeah, maybe the quid pro quo of that is we don't hang the billionaires. You get to keep what you've got. We're not going to kill you, but you have to make sure that everyone else now catches up.
Thanks for joining us for part 2 of our interview with global strategist Michael Every. If you haven't yet watched part 1 of our discussion with Michael, in which he predicts we're headed into an era of great change and disruption, as events will force real structural change on our leading institutions and geopolitical partnerships, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment perspective that Michael and our partners at New Harbor Financial share in this video. And don't forget to support this channel by first liking this video and then clicking the red subscribe button below, as well as that little bell icon right next to it. If everyone watching right now takes these 2 simple steps, it really does make a difference in helping this channel reach a lot more people. Okay, let's get started watching part 2 of our interview with Michael Every. All right, well, as we get to the latter part here of the discussion, let's get into your market outlook. So much of what you talked about is lots of uncertainty ahead. I'm going to put words in your mouth, but I think lots of turmoil, right? We talked about the trap that the central banks are in, right? Really, no matter what they decide, they're going to lose, right? There's going to be negative repercussions. And you've mentioned many times about the ridiculous levels that many asset prices have risen to. And we didn't get into this discussion, but I've gotten into many prior ones with past experts on almost any sector of the financial markets you look at. They are trading at all-time high levels of valuation, not just prices, but valuation metrics. And you look at that and you look at your predictions of what's going to happen with the economy, what's going to happen with blowing up geopolitical alliances and whatnot right now. It is hard to see anything other than a soup of things that markets tend to not like. So let me ask you, with your investing hat on and looking at the markets from here, what do you think is most likely to happen?
Okay, near term, the big issue is policy error or not. Do central banks hike as curves are now pricing for, or don't they? And if they do, policy error, crash, deflation, as much as that's possible with supply side inflation, and serious problems. If they don't, more of this Bitcoin idiocy, for as long as it can last, until eventually central banks feel they do have to do something. But to be blunt, what I find more interesting than that, even though that in itself, we're already talking about huge upswings and downswings, what's next? After the system has proven itself to have failed, either through yet another 2008 style policy error, or policy continuity, but the physical economy experiencing 2008 because you just don't have stuff relative to the supply of wealth for some individuals. What does the structure then look like? And I do most of my thinking on those grounds. What does political economy look like? Do we see monetization and modern monetary theory and central bank digital coins and helicopter drops into people's accounts, but you have to only spend it on made in America products? Do we see that behind tariff barriers? Do we see it behind a sudden really genuine shift to make in America or make in Europe or make in Japan? Do we see geopolitical lashing out where people basically try and blame other people and reflate the economy through more traditional methods, shall we say, which we've tried on and off over the past couple of 100 years? Or do we just see complete chaos because no one's in charge and no one's actually able to understand what to do? Each bloc or each country is going to be in a different position. Europe's ability to do things will be different to America's, will be different to Japan's, will be different to the UK, will be different to China. But I really, and have done for about 5 or 6 years, focus purely or mostly on understanding after this, what then? Because You can hedge the policy error that's coming up. You can't hedge what's following.
All right, so that's our next interview, Michael. Our next hour-long interview is going into that part. So a little unfair of me to ask this, but I'm going to say most of our viewers here are U.S. viewers, and if you're from a different region of the world, folks, sorry, we'll get to that in that next hour interview with Michael. But in terms of what you think is more likely to happen, and I'm not going to hold you to this as an ironclad prediction, but looking at the U.S., we have the crunch, the breakage of the system. Given that long list of possibilities that you just mentioned, which do you think are more likely?
The one that's most likely to me is going to be a combination of the populist elements of Joe Biden's policies and the populist elements of Trump's policies. So it's going to be a much more America-focused, America-centric, make America great again, but working class, and hopefully, ticking all the right boxes in terms of keeping everyone happy, demographically, focus, which will be enormously disruptive to global markets that rely on the international flow of dollars, and the US dollar is the freely available currency to trade everything off the back of. And in terms of presumption that the US will be the world's largest importer forever. And indeed, the overall structure of this ridiculous system we have today, where after we finish speaking, I'll go and check, what other newly created asset has suddenly become worth billions of dollars. All that will go up in smoke. I think that's my logical guess based on history.
Okay, great. And let me just see if I can restate that a little bit. You tell me if I'm restating it incorrectly. Right now we have kind of an anything goes environment here in the States, and that's allowing the people at the top to concentrate their advantage to get ahead even further, right? And that's why we have these, we have a quarter trillionaire right now in Elon Musk, right? The world's first quarter trillionaire, right? It sounds like what you're saying is it will be a bit of a return to more of a focus on the working class, which I've got to say, after the middle class just getting completely eviscerated over the past couple of decades, that might not be the worst thing in the world. It might be limiting some of the upward mobility of the top echelon of folks in America. We're already beginning to see, wealth taxes proposed on billionaires and now shifting down to millionaires, and ideas of Janet Yellen talking about a unrealized capital gains tax, which is a little crazy. But it does seem a little redistributive, right? Like, hey, we're not going to let you guys walk away with all of the pie, and we're going to sort of forcibly try to keep enough of it on the lower classes so that it's quote unquote fair. And maybe that's political speak for quote unquote they're not going to pull out the guillotine and hang us politicians or kill us politicians. I see you sort of nodding as I'm saying this, so I'm not too far off base here.
No, you're absolutely right. I mean, to put it in more kind of traditional macroeconomic terms, you'll probably see huge government spending supported by the Fed, which will no longer be looking at the stock market, but looking at the physical economy. And we're moving towards that. They can use central bank digital coins to try and accelerate that process in terms of where money flows to and to micromanage the economy, which China's already starting to do. But you do that with made in America caveats, again, using maybe digital currency to understand who's trading with who, so it can't just flow offshore. You do that behind tariff barriers. You do that alongside a spending plan where you subsidize companies to bring production home and raise wages. And yeah, maybe the quid pro quo of that is we don't hang the billionaires. You get to keep what you've got. We're not going to kill you, but you have to make sure that everyone else now catches up. Yeah.
And is it fair to perhaps assume that along with all that spending will also come a stronger tax regime?
Well, I would think so, because people will have to contribute. I mean, corporations would have to. Ironically, if you're basically electronically creating money, you don't have to tax in the same way. But it's all about power. You have to make sure they don't have the money to bribe the next set of politicians to reverse the policy.
Right.
That's what it really comes down to. Kill the lobbyists, and you entrench the system that you want.
Okay, and I just want to underscore as well that type of vision does jive a lot with what Neil Howe is telling us is just what you sort of expect from a fourth turning. You expect to see much more centralized control. And frankly, you expect to see a demand for more centralized control from the populace. So, you've got the folks running the system wanting to take more control over it, and you have the folks that they're ruling over saying, yeah, we want strong leaders here at this point. All right, so perhaps unfair of me to ask you this in the last couple of minutes here, Michael. I know you do not give financial advice, you do not manage money, but as you look, and let's say with a shorter term lens, sort of for the towards the kind of breakdown that you were talking about, do you have any advice for the concerned investor who's just trying to prudently protect their wealth, maybe prudently grow it through these times ahead? Any general advice for them, and or are there any asset classes that you particularly think are prudent to consider owning, or ones that you wouldn't touch with a 10-foot pole?
Okay, let me start with the 10-foot pole because that's where I begin more naturally. I would be very careful in terms of geographical placement, and that's got to be a product of how you actually think in terms of geopolitics. Now, people can disagree with me entirely. I'm not claiming I've got a crystal ball or can see the future, but think about how you think the world will look, and don't presume it's like a flat earth where all countries are equal. Don't look at a chart and say, well, that country's equities have really underperformed for the past year, therefore they must be cheap. There may be a reason why they're cheap. Just because something looks different on a line, do a bit of digging into the geography and the politics and understand why that might be the case, because sometimes they just diverge and they don't come back up again. So that's one. At the other end of you probably got to dive in. Let me be blunt. I'm not talking my own book, but I'm increasingly tempted with my own money to put 1% of my assets into complete digital crap. Because, if there's a digital crap ETF, 1% of your money in it, if that's spread across, 1,000 different complete jokes, who knows? One of them might be the next Elon Musk, at which point suddenly I can afford to retire tomorrow and, and I'll do these calls for pleasure rather than for any kind of financial remuneration.
But so that's sort of your short term. If you can't beat them, join them.
Exactly, but a very, 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 very small slice, just logically, but given the returns that you can get. But in between that, I really think, as I said to you last time we spoke on a different platform, preservation of capital, I think at the moment in this kind of volatile environment is far more important than trying to think I can pick up an extra percentage point here or an extra couple of basis points there. Right. When you see how volatile things can get.
So let's dig into that, because one thing you could do is just move to cash, right? And cash is vulnerable to inflation. And so that's one potential risk. It also raises the question, do you just put it all cash in your home currency? Do you distribute amongst other currencies? When you think about capital preservation, do you think about it as just being in cash, or do you think about it as sort of like some of the, tried and true traditional safe havens, like, maybe some treasuries, maybe some commodities like a precious metal or something else?
Food producing land.
Food producing land. Okay.
Yeah. Land in itself, okay. But if it doesn't actually have any water and can't produce food, it's a fraction of the value of land that, if needs be, you could grow food on, for yourself or at scale. I'm not saying this because I'm a tinfoil hat, duct tape and shotgun kind of guy. And those who know me know that I'm completely the opposite. But genuinely, that's an area that's likely to see outsized returns, whatever kind of paradigm you have going forward, even if it's just for climatic reasons, that there'll be an upside to anything that can produce food. And it's pretty safe.
Yeah, and don't worry, Michael, in my previous life here that many of these viewers of this video know me from, it's really about resilience. It's not about building a bunker and hiding from the world. It's just like you were talking about with the supply chains, right? It's just living with greater resilience. And, obviously you can go buy, your own acreage and build it into a food production system on your own if you want to. A lot of people don't have the youth, the vigor, the interest, the time to do that. I did get into many different ways in which you can invest in productive farmland in this video right here with Craig Wishner, Managing Director of Farmland LP. So if you are interested in learning more about what solutions about like what Michael was just talking about there with investing in land, that's a good video to watch. All right, Michael. Well, look, as we wrap up here, thank you so much for your time. It's always such a great, fascinating interview with you. We need to schedule 2 hours for our next interview. But for folks that have really enjoyed this discussion and want to learn more about you and follow your work, where can they go?
Well, I'm afraid my direct work is for clients only, but I do appear quite frequently on Zero Hedge. So usually like with a 24-hour delay after I've written a piece, but if for those who can afford to wait that long, which hopefully is most people, if you Google my name, Michael Every and Rabobank, there will normally be quite a lot that comes up.
All right, great. I'll put up the Zero Hedge URL here so folks that are interested can go there, type in Michael Every, and I think they pick up your daily almost every day, Michael. So that's they'll find a lot there. All right. Well, look, I cannot thank you enough again, Michael. Really appreciate it. Really appreciate you taking the time on a busy morning, your time there in Singapore. Thank you so much, and look forward to having you on the program again.
Thank you. Me too. Thank you for the opportunity.
Okay, now's the point in the interview where we switch and talk to the lead partners at New Harbor Financial, the financial advisory firm officially endorsed by Wealthion. We're going to react to what Michael said, but also talk about what the market has done since last week's video. John Lodra, Mike Preston, great to see you guys again.
Hello, Adam. Nice to see you.
Good to be back with you again, Adam. Thanks so much.
All right, well, look, another great mind, Michael Every. God, just such a big thinker. Really, really helpful to get his perspective, kind of looking at the macro situation, being situated outside the U.S., both in terms of some of the things he told us about the Asia market that maybe we don't think about on a day-to-day basis, being based here in the U.S., but also, interestingly, a lot of the similarities in terms of the conclusions that he's drawing that a number of our recent guest experts have as well. And guys, let's start with his commentary about how no matter what the central banks of the world do next, it really is a losing proposition for them. He talked about how if they tighten, they lose. If they continue stimulating, they lose. If they just play for time and delay, they lose. He also talked about kind of the inevitability of needing to redraw the supply chains around the world, and that's going to create a lot of disruption, at least in the near term, as those new sort of, both supply lines and geopolitical alliances get redrawn. That's probably a process I'm going to guess is going to be measured in years, maybe even decades. But everything I took from what he said was to say, hey, look, we are staring at an era of disruption coming ahead. And I think he used the word disaster. I'll be a little nicer and say disruption. But of course, that led him to saying, look, I think from an investing standpoint, capital preservation is the top priority right now. But Mike, let's start with you. What else did you take away from Michael's words there?
Yeah, let me answer first the question about the Fed is trapped. There's a lot of different ways to say it, but the Fed is trapped. Almost certainly. They have printed money like crazy the last 10 to 15 years. They taught the rest of the world's central banks how to do it and exported that around the world. And so we have all the major economies printing money like mad, a total of $27 trillion, I think, since the financial crisis. It was like 16 trillion just a few years ago. In 2016 and 2017, we're up to 27 trillion. And that's just in assets that have been added to central bank balance sheets, or money that's been printed, which has been further magnified through fractional reserve lending. It's caused worldwide debt to go from something like 180 trillion to almost 300 trillion now, worldwide debt. And all of that is only serviceable with rates near zero. Rates go up, the whole thing is over, So everything, the entire system relies on this plan A, because there is no plan B. And that's why we think it's kind of a crime what central banks have done. They're certainly smart enough to know what they're doing. We just wish they would have been more honest about it, because we don't really think that there's a plan B. This has to work or else. The whole system needs it, and we weren't asked to vote on that, or weren't asked our opinion on it. And I think that's a real problem. So we think they're trapped. We think there's a moment of reversion to the mean coming. I know it sounds somewhat repetitive to say similar things every week, but it's the single most overvalued market by ways that we measure it in US history. Even the Shiller price earnings ratio, even unadjusted, is up right around 40 right now. If you adjust it for other things like profit margins, it's above 50. If you look at stock market cap to GDP, the Buffett indicator, it's at all-time highs, well over 200%. So, that's my response to is the Fed backed into a corner? Yes, absolutely. And I'll just say one or two quick things about your other talk about times of disruption and opportunity. We are almost certainly in a fourth turning. A lot of your viewers will know what that means, but it's time of maximum effort, maximum change, maximum risk. And almost certainly there's going to be opportunities that come out of that. There's going to be risk and danger going through that. And we think the investment opportunities were going to probably come about elsewhere in the world, emerging Asia, maybe even Latin America, emerging markets in general. It's not to say that they're going to be a straight line higher from here, but the era of investing in the USA because it's the cleanest dirty shirt, it's probably ending, and there's going to be opportunities elsewhere.
All right. Yeah. And, Michael mentioned a little bit of that where he talked about how, right now sort of China's the 800-pound gorilla in Asia from a trading partner standpoint, but that he thinks that, supply lines and trading partnerships are going to get redrawn here, and you're going to have sort of these multiple centers of excellence there that he talked about. And to your point, Mike, there should be some very, interesting investment opportunities in those economies, those nations that are participating in those. So again, it's not all doom and gloom. You mentioned the fourth turning, and I'll just repeat what Neil Howe said. He said, hey, it's going to be different, the way that things are going to be structured coming out of this fourth turning, but that doesn't necessarily mean worse. And yes, it's going to be a painful ride going through all that uncertainty and that disruption. But it doesn't mean that we're, heading into an Armageddon period. It just means we're heading into a new period that's going to have a whole brand new set of opportunities there. So that's a big part of what we're trying to do here with these videos is see what's coming. And yeah, while we may have a period where we're going to need to batten down the hatches, what we're really, we'll be battening down those hatches so that we can make it through the storm and then have the potential to invest in lots of the upside that'll hopefully come afterwards. John, let me hand it to you. Anything else to add to what Michael said?
Not too much. I guess the geography point that he raised about, geographical selection is likely to be all that much more important. We agree with that. Last number of years, it's been all about the U.S. markets, more or less. Most global markets and emerging markets have trailed, and the silver lining of that, I would say, is that the valuations of those kinds of geographies, especially emerging markets, are that much more attractive on a relative basis than the U.S. market. So, not to suggest that in a kind of a material sell-off in U.S. markets that overseas and emerging markets would be immune from any kind of pullback. That's not at all what I'm saying. But aligned with those economic shifts geographically, we think that the selection of investments are going to be really important. We have long favored emerging markets for these last several years relative to U.S. stocks from a longer-term valuation standpoint. We continue that. It helps that many of these countries are resource-based economies, which in an inflationary environment should help support those countries. But just anecdotally, supply chains are on everybody's mind. I tried to get some new brake pads for my bicycle a couple of weeks ago. I got the last one in the shop, and to order more, the backlog is out until like February, March of next year. It's pretty crazy. But I was talking to an executive of a cosmetic manufacturing company, and one of the big bottlenecks in their business has been packaging, containers and things like that. And they've talked about an attempt to re-onshore some of that packaging that would oftentimes be outsourced or sourced from China and other overseas markets. Yeah, there's going to be big economic shifts that I think will have overtures into investment allocations.
Yeah, well, let's dig into that just for a second here, because a key takeaway, from the conversation with Michael is we talked at the beginning of the interview about just the ridiculous dissociation right now between the financial economy and the real economy. And I want to give sort of two juxtapositions. Michael and I were kind of ranting about the appreciation in Shiba Inu, which is, the knockoff coin of Dogecoin, which is a knockoff coin of Bitcoin. I'm going to put up the headline here from an article today that appeared on Zero Hedge. It basically showed that there was an investor here who put $8K into Shiba Inu last year, and it's now worth $5 billion. And when you can have that kind of just mind-boggling wealth, basically just, cogitated, out of thin air, it shows you where we are in this story, right? Where we're literally living in a fantasy land when it comes to the pricing of financial assets these days. Now you contrast that to the real economy, where the prices of essentials are going up because we literally can't get our hands on them right now. I mean, the supply chains are breaking down. And so, most of the conversation that I had with Michael really was about kind of the real economy and how it's going to have to be redrawn and made more anti-fragile and all that stuff. And I think back to a interview I did earlier in the year with Steen Jacobson from Saxo Bank, who was very big on again, on the real economy for a number of reasons, but basically because so much of our infrastructure worldwide, but especially here in the States, is aging. It needs to be replaced. And that's true of many countries right now. So there's increasing global competition for the resources just to rebuild our bridges and highways and ports and things like that. Not even forgetting about wanting to electrify our transportation grid and stuff like that. Steen also made the really interesting observation that, and this was before supply chains really broke down, was that the digital economy was getting so good at selling products, Amazon and whatnot, people clicking the buy button to get a product, but it was finding itself constrained by the number of delivery trucks, delivery drivers, distribution centers, et cetera, where these real world physical constraints are becoming the bottleneck on the digital economy going forward. So where I'm going with all this is it really does shine a bright light that, investing in real things, commodities, the companies that mine them, and the companies that then transform those raw commodities into value-added products, there's really big investment opportunity there. So John, let me let you just react to that, and then Mike, I'm going to ask you about what the markets have done over the past week.
Yep, no, real things. The inflation we're seeing there, we don't think is a mistake. There's the disjointed supply chains, but yeah, I mean, anytime you kind of make an imbalance of supply and demand, and certainly there's lots of stimulus sloshing around out there still that has stressed from a demand standpoint the supply chains. Many times people think of tangible assets and they think of real estate. That real estate can be a great place. Michael, I think, nicely talks about land with productive food growing capabilities, as being a good place. We totally agree with that. Certainly land, but with that income and inflation hedging capability, not to mention to be able to feed human beings, is a really important place to be. I will caution, however, that many forms of real estate are in their own bubble-like states. Making the news this week is that the median home price in this country surpassed $400,000 for the first time ever, and I think the year-over-year increase so far is a record, or certainly a record in any recent years. So we've seen massive appreciation just in the last quarter. I think it was up like 13% nationally. So we've had this massive ramp up in home prices, which obviously is kind of important to humans to be able to find shelter. And this of course ties back into the notion that the Federal Reserve is entrapped, because to let these kinds of things run further amok just means squeezing everyday people more and more. Yet the antidote to that is to raise interest rates and withdraw some of the stimulus. And when you have a economy, everything from households to corporations to governments, as indebted as they are right now, the system almost can't withstand that. So, there's no good choices here.
Yeah, no good choices. And it's on so many different dimensions. Just hearing you talk there, John, was thinking, that the Fed, on one hand, it's damned because, if it were to raise rates, it would create our asset prices, crash the system, make everybody angry, but particularly make, sort of the oligarch class that the Fed sort of, responds to, incredibly angry at the Fed. So all that political pressure, right? But of course, if it continues to let inflation run hot, you get to the point where you have a critical mass of just the public, the masses themselves getting to a point where they can't take it anymore and start rising up. So it's almost like, what's worse for those guys, the punishing power of the oligarchs, the punishing power of the public masses. I don't know, but it just seems like, again, no matter which road this goes down, there's going to be a reckoning for them. And sadly, we're all going to be the collateral damage of that. So, all right, Mike, let me move over to you. Let's talk about what the markets have done since last week. Let's talk about the major indices in general, and then we can talk about, a couple specific asset classes like gold, crypto, and a few others.
Yeah, it's just a story of all-time highs, really, just about everywhere, continually. The S&P sitting here right around 2,600. It had a 4% or so pullback, and just in a matter of days, over the last week or a little more than a week, it went right back to its all-time high. And the trend has been relentless, to say the least. The tech stocks, the FANG stocks, have been a big part of that. There's a lot of days where breadth is negative. There's actually more decliners than advancers, and yet the indices are up quite a bit. And it's just the strong stocks. Microsoft, Google, Apple, and Amazon both report tonight. But by and large, the reports have been greeted very, very favorably, and these stocks have been breaking out. Then, of course, there's the poster child stocks like Tesla, which added another 150 or 160 billion dollars the other day on news from an order from her. It's a rental car company. And these stocks are just moving gargantuan amounts based on the fundamental news related to them. And it's just, you were talking about that crypto earlier, how an $8,000 investment is now worth $5 billion. Nothing really seems to mean anything anymore at the moment. And we are in a mania. We're convinced of it, but certainly it feels interminable, like it's never going to end. We feel very strongly that it will. But so the S&P's there at all-time highs. The breadth and the internals are not good, yet the market is there based on the strength of a few stocks. Volatility is at multi-month lows. The VIX, the volatility index, is down at 15 or 16. It hasn't been there in many months. That's at year lows. And lastly, I think we should probably talk about gold and silver. I mean, if you look at the charts of gold, silver, gold, particularly to me right now, it's one of the few things, as frustrating as it is, that has not gone vertical. And gold is in this long sideways triangle-shaped consolidation going back to August of 2020, going on almost a year and a half. A big consolidation. It looks to us like it wants to break out to the upside. There's been 2 tries to break out to the downside in recent months. Looks like it wants to break to the upside. 1,800 right now on gold would project to around 2,500 if it broke out to the upside out of that triangle, just on basic projection from technical analysis. Obviously, that's not a guarantee, but there's nothing really to buy here today that has any sane value attached to it, other than maybe some gold, silver, some select foreign markets or emerging markets, base metals, commodity type plays. So heavy cash and exposed to those areas is what we think continues to make sense. So we'll watch and wait.
All right. Well said. Just to build on that a tiny bit, I guess I do want to give props to David Hunter, who we've had on this program, and he's had the most, courageous, some would say outrageous predictions over the course of the year, but many of them have been coming true. And David has very publicly said he expects this latest secular bull market to end end of this year, beginning of next year, and to end with a epic blow off top, just an epic mania. And that I think, to your points there, Mike, could very well be what we're seeing here right now. And I think back to the famous McKay book on the madness of crowds, right, where men go mad in herds. And that's what you see at the end of every bubble market, where everybody rushes in, everybody throws caution to the wind. And that's when you get, a tulip bulb that sells for more than the most expensive building, in Amsterdam, or you get a Shiba Inu coin that investment that goes to $5 billion or whatever. But we do seem to be seeing Hunter's, prediction playing out here. You mentioned the S&P at an all-time high, and you mentioned VIX at series low. I just want to put up this chart really briefly. I put in my recent video on stagflation. It's a chart that was put up by Sven Henrik that shows that the VIX to S&P ratio has never been lower. And that again just shows an all-time high in market complacency, which is exactly the kind of extreme you would see before you have some sort of violent correction in the market. So again, not saying that indeed is going to happen next, but we're seeing all the hallmarks of the potential for that happening. And then last, I just want to mention, folks, Mike, you talked about the precious metals being still one of the attractively valued sectors out there. Just released a video yesterday from Jeff Clark. It's an hour presentation going through his top picks for the precious metals mining stocks that he thinks would perform the best. He's talking like 10 bagger, 20 bagger returns. Should we indeed have a catch-up phase here in the precious metals where their appreciation catches up to the type of appreciation that we've seen in other commodities this year? So folks, if you haven't seen that, go to wealthion.com/Clark and you can watch it there for free. All right, John, I'll let you have the last word here as we wrap things up for this week. Any parting words of advice for today's viewers?
Just to not lose sight of where we likely are in the cycle. I'll reference back, like you just did, Adam, to the video that David Hunter did with you a few weeks back. Our message there was, and I think his as well, is like, his call for a near-term melt-up wasn't a call to say, hey, everybody should be plowing their money in the stock market, because he did call for up to an 80% meltdown after that. And our point in that was just to understand what that kind of move likely represents and what it likely will do to one's psychology, and to be in control and aware of that, to not get sucked in, because the likelihood of getting sucked in and getting out successfully is very low. But instead to use that as almost fortification to say, hey, I know what this is all about. It's craziness, and I'm going to be strong, and I'm not going to let myself get sucked into the craziness, because I know that very high likelihood there'll be much better times, much safer times ahead to be investing like a true investor, and not a panicked, FOMO, anguished, investor that these markets are making everybody want to be. And it's not to point the finger at anybody. These are very difficult emotions to wrestle with. That's why so many people get sucked in.
Yep, and that's why we are so emphatic in recommending that people work with a professional financial advisor when it comes to managing their financial portfolios, given the current era, to work with a professional who can take the emotion out of your decision-making process, right? And if you're a new viewer here, you heard Michael say, focus on capital preservation going forward. You've heard what Mike and John here have had to say. If you have a good financial advisor to be your guide through the type of future that's coming, great, stick with them. But if not, Mike and John and their team at New Harbor, they offer free portfolio consultations where they'll sit down with you. They'll look at your current allocation, they'll look at your goals, they'll look at what they think the future holds, and they'll just tell you what they think you should do. And you can do whatever you want with that. You can, implement it yourself. You can implement it with your existing advisor, or if you decide you might want to work with these guys, there's the opportunity to do that, but there is no commitment to do that for having these free consultations. If you'd be interested in having one, stick around at the end of the video. We tell you how to schedule one. It only takes you a couple of seconds to do so. All right, if you want to see continued great interviews like this with folks like Michael Every and the other great guest experts we've had on this channel, please help support this channel by hitting the like button first, and then clicking the subscribe button below, as well as that little bell icon right next to it. And if you'd like to see which guest experts we have coming on this program in the near future, or even better, suggest ones that you'd like to see, just follow me online at Menlo Bear. I do look at every suggestion that people make there. All right, John and Mike, well, another great week. And whatever the markets do from here, we'll be tracking it together on this program. I'll see you guys next week. Everybody else, thanks for watching.
We'll see you
Thanks, Adam.
soon.
We'll see you next week.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to Wealthion.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.